I'm Anindya Chatterjee, and I'm the lead portfolio manager for FIRA's emerging market strategy in US. My investment focus is emerging markets. I do want to highlight that domain knowledge is key for emerging markets investments. Now, I was fortunate enough to work in key emerging market locations like Hong Kong and Singapore and Mumbai. I've worked more than 24 years researching emerging markets. We combine our top-down investment philosophy with a detailed, disciplined, bottom-up research process. We invest in emerging markets. We believe in boots on the ground. We have a team based in Hong Kong. I have analysts based in Hangzhou and in Mumbai, in China and India. And I travel more than half the time meeting companies, understanding the underlying socioeconomic, cultural backgrounds on what works and what does not work when it comes to business strategies is very key. So when we identify companies and interview managements, domain knowledge becomes very essential in understanding whether their strategies would work or not. We take a top-down approach and combine it with very detailed, disciplined, bottom-up research to invest in companies in emerging markets, particularly in emerging Asia. Our top-down investment philosophy is based on 4 key macro pillars. These are long-term, behavioral, sticky macro variables that don't change over time. These are ingredients that help us identify economies that can grow robust and sustainably, in our opinion. We see nonlinear growth in consumption as we study countries over time and in cross-section data. As disposable incomes grow, people consume things for the first time in their life. And from toothpaste to automobiles, we see nonlinear consumption growth in economies when their per capita income grows from, say, $2,000 to $4,000 to $10,000. In our investment domain, we see this prospect of nonlinear growth in consumption, and that's our investment focus, the rising middle class in emerging markets. Our focus is on the rising middle class in emerging markets. Now, we also invest in exporters where we believe they have long-term sustainable competitive advantages. When we look at companies, we look for reasonable earnings growth, reasonable valuations, and a reasonable degree of earnings visibility. This gives us the nimbleness to move across sectors and markets based on earnings visibility. Our macro investment philosophy helps us identify the countries where we want to invest. And once we have done that, our detailed bottom-up research process involves several steps. We would read the research on the street. We would meet industry specialists. We would have several conference calls with the analysts. Typically, the companies that we are looking at, many of them would not have wide market coverage. It would require a lot of proprietary research. We would do our own proprietary surveys. We would meet the management several times. We would be on the ground seeing the facilities of these companies. I am half the time in Asia traveling and meeting managements, and my analysts on the ground are doing it continually. In this process, it helps us build our own proprietary financial model. So that's how we look to get an understanding on the true intrinsic value of the company that we are researching. We have a bias on mid caps and small caps in our strategy. Now, when it comes to mid caps and small caps in emerging markets, only a few analysts would typically cover them. So there's not much support that you can get from the street in understanding these companies. And here, domain knowledge and our proprietary research becomes very crucial. Our objective is to identify tomorrow's leaders in the domain where we are investing. Now, having said that, domain knowledge is key, when it comes to investing in emerging markets, as I had mentioned. But particularly when you are looking at small caps and mid caps, you need to have a true understanding of their business prospects, of the space where they're in, the prospects of their strategy that they're detailing when you're meeting a management, of the probability of their success as their track record is not yet proven. Liquidity risk is high in our radar, and we make sure that we do not expose our underlying investors to undue liquidity risks. We are cognizant of the liquidity risks in emerging markets. Now, when we invest in small cap and mid cap companies, we do not invest in companies that have market cap less than $1 billion, and average daily trading volume has to be typically more than $2 million. I'm supported by two senior analysts in Hong Kong, and they have each more than a decade of experience in emerging markets research. Our senior analysts in Hong Kong are supported by two full-time consultant research analysts, one in Hangzhou, China, and one in Mumbai, India. They support our senior analysts in their number crunching. They do our proprietary on-the-ground surveys and channel checks. I spend more than 50% of my time traveling. When I'm on the ground, I meet industry specialists, I meet policymakers, think tanks, and managements of companies. I just came back from China less than 2 days back, and I was on the ground meeting from the central bank research departments to their fiscal policy research departments to banking sector regulators. And I met more than 40 company managements in this trip. This is just regular process for us. Our analysts are meeting companies, industry specialists, and analysts of the sell side all the time. I want to talk about how we actually work day to day. We are connected by technology. While we are spread out across the globe, we are communicating on a constant basis. So we are connected, and more importantly, we can access each other's work through a cloud platform where we share our research. So it is a seamless, continuous communication, and we do not feel this difference in space and time at all. Our strategy has a significant exposure in China and India. Why is that? Now, China and India fits so well in our 4 key macro pillar criteria. China and India both have large populations. India has a large young population. Both these countries have per capita incomes less than $10,000 and are experiencing rapid growth. We see rapid, in our view, non-linear growth in consumption both in India and China in years ahead. China and India both have very high savings and investment rates. We believe high savings and investment rates are key prerequisites for sustainable, robust economic growth. We have a large exposure in emerging markets technology sector. Now, this also ties back to our 3-pronged criteria of reasonable earnings growth and reasonable valuation and reasonable degree of earnings visibility. We saw improved earnings visibility in the technology sector, as in these emerging economies, we saw higher penetration of smartphones, internet penetration, adaptability of the younger population to technology. Technology companies across the board have improved visibility in earnings. Our exposure in the technology sector in emerging markets range from internet, e-commerce, to cell phone supply chain, to consumer tech. Much of these are experiencing structural tailwinds of transformation in these economies from what you would call an old economy to a new economy, and is supported by the demography, the large base of young population, and their adaptability to technology.